Most investors wait for companies like SpaceX, Stripe, or OpenAI to go public, but by the time they do, the biggest gains are already gone. Valuations are inflated, early investors are cashing out, and you're buying in at the exact moment the upside becomes the most limited. Here's what almost nobody tells you about this. There's a group of qualified investors who are getting in before all of that, before the IPO, before the hype, before the headlines. And they're doing it using a structure most qualified retail investors have never heard of. It's called an SPV. Stay with me, because once you understand how this works, you'll see the investing world completely different. Many years ago, I was talking with an investor who casually mentioned he had owned shares in a private company you've definitely heard of. At the time, it wasn't public, no ticker symbol, you couldn't buy it anywhere. And I remember thinking, how is that even possible? Because most people assume that kind of access requires insider connections, tens of millions of dollars sitting around, neither of which most investors have. But the reality is more accessible than that. This is structure that allows groups of investors to pool capital together to access opportunities that would otherwise be completely out of reach. That structure is a special purpose vehicle, or SPV. And once you understand how it works, it opens up a layer of investing that most people don't even know exists. So what exactly is an SPV? An SPV is a legal entity created for one specific investment, one deal, one purpose. For example, instead of needing, say, $10 million to invest directly in a private company, a group of investors come together, each contributing a portion. Then they invest collectively as a single entity. That entity, the SPV, is what actually holds the shares. You own a piece of the SPV, which owns a piece of the company. It's a simple structure, but it has significant implications. This investment strategy isn't something new or experimental. Institutional investors, family offices, and high net worth individuals have been using structures like this for years. The difference is that most qualified retail investors have simply never been shown how it works. There are three reasons sophisticated investors use SPVs, and they're worth understanding clearly. The first is access. Most private companies don't want hundreds of individual investors on their cap table. It creates legal complexity, administrative burden, and ongoing headaches. But if a single SPV shows up representing 50 investors, that's clean, that's efficient, that gets deals done, which means investors in the SPV gain access to opportunities that would otherwise be entirely locked out of. The second is deal size. Private investments typically carry high minimums, millions and even sometimes tens of millions. That automatically excludes most investors. But within an SPV, those minimums are divided among the participants. That same deal that required $10 million to enter directly might be accessible for as little as $100 or even $50,000 in some cases through a properly structured SPV. Same opportunity, different levels of entry. The third and most overlooked is expertise. The real advantage of an SPV isn't just access to a deal. It's access to the person sourcing it. Every SPV is led by a sponsor, someone with relationships, expertise, and deal flow in that specific space. They're the ones finding the opportunity, negotiating the terms, conducting due diligence, and structuring the investment. Rather than trying to evaluate a complex private company on your own, you're leveraging the expertise of someone who operates in that world every day. That distinction alone can dramatically change outcomes. Now, before this starts to sound like a shortcut to easy returns, let me be direct about something. Private investing carries real risk. These are illiquid positions with longer-term time horizons and no daily pricing. There's no easy exit, companies can fail, and outcomes vary widely. This isn't about replacing your existing strategy, it's about understanding a tool that most sophisticated investors use carefully and selectively as part of a broader approach to building wealth. The investors who do well with SPVs aren't the ones chasing the most exciting deal. They're the ones who are disciplined, who understand the structure deeply, and who know how to evaluate an opportunity before committing capital. Which brings me to the piece most people overlook, being selective. Just because you can invest in a private company through an SPV doesn't mean you should. The best investors in this space ask very specific questions before they commit. Who is leading the deal and what is their track record? Where is the company in its life cycle? And what does the realistic growth look like in the future? How is the SPV itself structured and the terms, are they favorable? What's the genuine downside scenario? And what is the upside worth? And perhaps most importantly, does this actually fit into a broader investment strategy or does it just sound exciting? Because SPVs are not the opportunity, they're the vehicle. The opportunity is understanding how to use that vehicle correctly. With the right deals, the right sponsors, and the right allocation relative to everything else that you're doing. Most investors spend the entire careers playing the public market game, buying what's already known, reacting to headlines, competing with millions of other investors for the same information. The investors who consistently build significant wealth are doing something different. They're allocating a portion of their capital to private opportunities, where pricing inefficiencies exist, where growth hasn't fully been recognized, and where access is genuinely limited. SPVs are one of the vehicles that make that possible. If you want to go deeper to understand how that might look for you, what to avoid, how to think about allocation, and how qualified investors are actually using that strategy, click on the link in the description to watch the full breakdown or schedule a call to learn more about how investors access and evaluate these kinds of opportunities. Most people spend their entire investing lives in the public markets, not because it's the only option, but because nobody's ever showed them the door to anything else. SPVs aren't a secret, and they're not reserved for billionaires or insiders. They're a legitimate, widely used structure that sophisticated investors have learned to lean on for decades to access growth before it becomes obvious to everyone else. The difference between investors who use them well and investors who don't usually comes down to one thing: understanding how the vehicle works before you get inside of it. So if the video opened a door that you didn't know was there, this is the moment to walk through it. Click on the link below to watch the full video or schedule a call to learn more. Because the earlier you understand how this works, the more options you have. Thanks for watching, and I'll see you in the next video.